This is All India Radio. In the program Spotlight now, we bring you a discussion on rationale and implications of India joining Global Minimum Corporate Tax Framework. The participants are Shubhamoy Bhattacharjee, economic analyst, and Shishir Sinha, journalist.
Shubha, 130 countries have joined agreement on global minimum tax for companies. And this is basically an attempt to address challenges presented by a globalized and increasingly digital world economy in which profit can be relocated across borders and companies can earn online profits in places where they have no taxable headquarters. What does it mean for India?
Companies, especially those not only in the technological sector, but also others who are now struggling in countries who are way too big, often end up as the biggest, the business entity in different countries, but they are not taxable in those countries. Or rather, most of the time, because of the fact that they don't have a permanent establishment in those countries, the ability of the respective countries to tax them remains extremely limited. As you know, taxation works on the principle that you got to be having a presence in a country before you can be called for taxation by the country's tax authorities. But when a product of a company is sold in a country, that doesn't necessarily mean that that company will be taxed by that country or can be taxed by that country because of the lack of the presence of any permanent establishment. And what do you mean by permanent establishment? Basically, a place from where the company is doing its business. So as a result, lots of times we get companies, obviously in the technological sphere, we are seeing all these companies, right from Google to anybody else, Amazon, Facebook and everybody, but even otherwise, when we are looking at companies whose products we are buying, that company, since it doesn't have a business presence in the particular country, the taxability of the tax authorities remains unsure, and often the companies are able to get away by through this loophole and do not have to pay the tax.
Under this arrangement, what we understand that we are talking the allocation of additional share of profit to the market jurisdiction, and the second pillar consisting of minimum tax and subject to tax ruling. The timeline as of now is understood to be 2023. Do you think this timeline is slightly ambitious?
Yes, it will be ambitious. And before that, let me connect with what we were discussing earlier. So what the current agreement essentially entails is that even if a company doesn't have an establishment in any country where it is selling its product, that country will now, under this international rule which has been, or international agreement that has been signed by the different countries, will be allowed to tax. And a company will not be able to say that, no, I don't have an establishment, so therefore you cannot tax me. The basis of taxation will be the amount of sales you do. So if the sales is above a particular threshold level, then, and if the company has been making profit, again, global profit on its activities, then that company becomes liable to be taxed in the country in which it is doing its business. This is significant because this means that countries don't need to work out that whether an establishment works or doesn't work. There are lots of complications, and those are now been totally eliminated. Instead, companies simply on the basis of the amount of sales that they're doing, and that is easily recordable data, the company will be taxed. The issue is about whether this sort of a thing, even though we are saying it's a simpler form, can this be done by the year 2023. The problem that comes along is that when we say that we are measuring sales, not every country has the ability, and typically developing countries do not have the ability to bring in the scale of measurement that is required to be able to make this transition. I mean, as it is, they were not able to tax earlier. This sort of a thing to be able to start rolling out, it will be difficult. Also, for countries like India, when we are specifically looking about it, while India has the ability to do it certainly, India already has established very strong rules of taxation of companies within the country on the basis of its own established tax laws. Many of those tax laws will now need to be changed, and direct tax laws are changed only with the Finance Act, which is the budget every year. So essentially that means that almost all the changes will have to be now brought in the budget of next year. once you change the law, then you have to say that you have to give a year's preparation time for that company to become assessed as per the new taxation formula. So we shall have to sort of, first of all, eliminate a lot of taxes and bring in fresh taxes as per the new norms. And that's just the beginning. There are several other issues there to be sorted out.
If I understand correctly, under this deal, the countries could tax their companies' foreign earning up to 15% if they go untaxed through subsidiaries in other. That would remove the incentive to use accounting and legal schemes to shift profit to low-rate countries where they do little or no business, since the profit would be taxed at home anyway. OECD estimated that such tax avoidance practices cost countries between $100 billion to $240 billion annually. Does this mean that we will not have a concept what we call as treaty shopping or tax haven?
Shishir, that is exactly what it's supposed to entail. Now, what does it mean? The treaty shopping is that today, many of the technology companies, typically, as you pointed out, establish their headquarters in a place where there's a very low rate of taxation. And these are the tax havens. Once having established the headquarters there, they claim to the country where they are selling that you cannot tax me because I have already got my headquarters in a XYZ place, and that is where I shall be taxed. And since with this tax havens, practically no developing country has taxation treaty, it is not possible for the developing countries to tax them. Why only developing countries? Even developed countries also run into similar problems. So that treaty shopping should come to an end. However, the point is that there are what we should say challenges to doing it. One of the first things is that, the proposal that was brought in by OECD was that all multinationals, irrespective of size, should be taxed at the place where it is doing its business. The American proposal, which has been accepted, is no, let's not do that. Let's have a threshold of the top 100 companies in the world. And how do you establish the top 100 companies in terms of their turnover, which is those with turnover of $20 billion or more. Now that seems plausible, but it also creates the challenge that company which is above $20 billion is going to be taxed in the country where it is doing its business. But in doing so, the country is opening itself to rules of taxation which has been set under this new format. So the country cannot say that if I have got, say, 30% rate of tax or a 35% rate of tax, I will impose that rate of tax. No. The rule says a rate of taxation shall be as per internationally settled orders, which does mean that countries like India may have to actually reduce rates of taxes on several of these companies before it gets round to start making the tax systems work.
If I go back to 2019, when the corporate tax rate was reduced to 15% for the newer project, that was mainly for the manufacturing sector, not for the services sector. The other thing is which I want to read from the press release by Finance Ministry just a day before, and it says that India is in favor of a consensus solution which is simple to implement and simple to comply. At the same time, the solution should result in allocation of meaningful and sustainable revenue to market jurisdiction, particularly for developing and emerging economies. What kind of challenges we can see in consensus setting?
When we say that we want it to be simple, that is obviously something that no one will have a contradiction with. But taxes of companies don't necessarily end up being simple, not because governments don't want it, but also often companies also don't want it. And when it is a question of taxing multinationals, then the problem becomes even more difficult. Now, what India had been doing so far had been that you may be a multinational in XYZ company, in XYZ country, but as far as we are concerned, if you are doing business in India, we presume that you have got a permanent establishment. Above a threshold level, if you're doing business, we assume that you've got a permanent establishment and you're therefore taxable as per the Indian tax law. This policy shall have to be given a go by. And India will have to accept the international norms of a taxation which says that you can tax all the companies, but at rates which has been negotiated globally. Now, as you can see that there are lots of issues here which will be about what do you mean by global rates of taxation, whether that is fair. Because let's take a simple example. Let's take names of companies and because that's unavoidable. Say Reliance Industries. is an Indian company. Now, it is a large company, but most of its sales happens in India. Whereas, so naturally, most of its tax will be paid in India, and that is what it does. But imagine a company that is abroad, like say a company like Amazon. Amazon is a company where most of its sales may be happening in some other place. Now the tax will be paid in that country. So now, if a country has less number of multinationals based in that country, the taxability of the country becomes actually lower. This is an important point to be able to understand, that it often, while the principle is right, it actually creates more difficulty for developing countries which were till now working on taxability on the basis of that we don't care where your headquarters is. We simply say that if you are in a country, we establish you as a permanent establishment. What India has done is that it has said that, okay, this is a new sort of a pattern of taxation that has been established. We want to give it a fair try. And that is what the quote from the press release that you're reading is exactly what it says, that we are entering into it with good faith. Let us give it a shot. Let us give it a effort. And then, depending on how the outcomes turn out, we will then change or make a position accordingly in subsequent rounds of discussions.
India, along with many other countries, are being criticized for the digital taxation, what we know as the equalization levy in India. Do you think that after the introduction of this kind of system, post 2023, we will see that there will be no equalization levy and only this particular system will come into effect?
That is almost certain. If you have this taxation principle, then the digital tax or the equalization levy, as we were talking about, will have to be phased out. That is one of the major things, as I said, in the finance bill will have to be reworked next year, because both taxes cannot be at the same time. Because the equalization levy clearly says that it's a tax of 2% on your sales in the country. Here we are saying that it is a tax which will be levied on the sales based on agreed formula on a particular type of companies, which is the companies above $20 billion and having a profit of a particular order in the global realm. So obviously the two systems cannot run simultaneously, and definitely the digital tax or the equalization levy will have to be given up by India.
If we go by the rate of taxation under equalization levy is just 2%. But when we talk about the new framework, minimum rate is around 15%. So the companies which do not have any permanent establishment in India or in any other country, so in that situation, the digital companies may have to pay more in a country like India?
My guess is that it will be lower. Let me put it this way. 2% on the sales, which India now insists, is being changed under the new law to say that you will have to pay 15% on if two things. If your profit is above 10% of your global sales and you come within that group of the top 100. Now within the top 100 also, the second pillar of this agreement says that the rate of taxation will have to be above how much above the 10% is the tax that you are asking for. Therefore, the base of the taxation is shifting from sales to profit. The companies who are under that framework will have a much more stronger say in ensuring where they are being taxed. Now, remember, even after this taxation system comes in, it's not that every country will have the similar rate of tax. So these things will have to be worked out about how companies manage their global sales and turnover issues. It is definitely true that India will get some amount of the tax. The critical point, as you are rightly pointing out, is whether it will be more than the digital levy is something that is being furiously calculated by the tax authorities now, and that will get more clarity once the actual rate of tax is settled.
Thank you very much, Shubhmay, for talking to us.
Thank you, Shishir.
You were listening to a discussion on rationale and implications of India joining Global Minimum Corporate Tax Framework. The participants were Shubhamoy Bhattacharjee, economic analyst, and Shishir Sinha, journalist. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app, News on AIR. This program is also available on our YouTube channel, News on AIR Official. You may email your opinion about this program at airnsttalks@gmail.com.